once they make tens of millions, the money becomes less significant. The game itself becomes the important thing.
In general, people lose money in the market. How do good traders cope with this?
There's one trader who says, the first time it took me 3 months to blow up. The next time it took me 6 months. The next time it took me a year. Most people would think I blew up 3 times, but he thinks I'm lasting longer. I'm obviously getting better. The markets give you a lot of freedom. But on the other hand, you're never free because Trump can tweet something and have a big market effect and you're sleeping. It's both a source of freedom and a source of enslavement.
What is the biggest misconception about successful trading?
Only a tiny sliver of the population has the innate talent to excel in any endeavor. Most people are not going to become market wizards.
Hello and welcome. It's Capital Horizons, the podcast where investment matters. I'm Igor Yelnik. My guest today is legendary Jack Schwager, the author of Market Wizards. Hello, Jack. Thank you very much for joining me.
You're welcome. Sure.
I read your first book, the original Market Wizards, about 30 years ago. As far as I understand, you started interviewing people for that book almost 40 years ago. And based on the decades of interviews for, how many is it now, 6 books, which trading principles have held up best over time?
Well, a lot of principles have held up throughout every book. Obviously, risk management is something that comes up, and not only in every book, but virtually, not every interview, but almost every interview. So the understanding that whatever your method is, whatever the market you're trading is, whatever the time frame you're trading is, ultimately, almost everybody has to have some sort of rigorous risk management approach, or else sooner or later they won't survive. So I guess that's something that has been uniform. And there are other traits which repeat over and over in every book. So, for example, people get attracted to the markets because they think it's an easy place to make a lot of money. And the irony is that if you read any of my books, and especially the most recent one, you should be struck by the fact that these people are incredibly hard workers and completely obsessed with the markets and devoted to just the bulk of their life to researching and trading the market. So there's a tremendous amount of work that goes into getting to where they are. It's not like a 40-hour week type situation.
No work-life balance.
Yeah, right. That's right. So you see them struggling with that as they've made tens of millions or hundreds of millions, as may be the case. Really struggling with, well, is this what I want to continue doing? Am I willing to devote this much time to just trading? So that becomes a personal struggle, actually, because it does require a lot of sacrifice. One trader put it this way. He said, it's kind of ironic. In one way, the markets give you a lot of freedom because you could trade from anywhere. You're your own boss. In many ways, it seems like it gives you freedom. But on the other hand, you're never free because things can happen anytime, not just during work days. In the middle of the night, Trump can tweet something and could have a big market effect, and you're sleeping. So you're never quite free. And if you go on vacation, the markets don't go on vacation. They're still moving. So in that sense, his point is that you're always kind of a slave to the markets because you're never completely free from it. So it has that dual effect. It's both a source of freedom and a source of enslavement, if you will.
I think that many people will ask, okay, once you have made hundreds of millions of dollars, when do you want to be a slave to anyone or anything? Why not just quit?
Yeah, exactly. So, I mean, if it was simply about making money enough money to live comfortably, certainly 100 million would do it for almost everyone. Uh, and even lesser sums would certainly do it. And that's why you do get this internal struggle with some traders deciding if they want to keep doing it. But it's not like an ordinary job for these people in terms of you have a job. In many cases, people have jobs to make money so they can do the things they want to do. In the case of the traders who are really successful, there has to always be a passion for it, where the endeavor itself is something they enjoy doing. If you look at the language of traders when they talk about the market, some of the analogies that have come up, I think Bruce Kovner called it a multi-dimensional chess game. Jim Rogers talked about it's like a 10,000 piece jigsaw puzzle, and they're always taking out some pieces and throwing in new pieces. And these are like game. Another trader talked about going through charts being like a treasure hunt. So you find again and again the language they use is a language of games, and that tells you that it's not a drudgery. It's not work in a conventional sense. It's actually something they enjoy doing. Uh, a common way if they express it, I've heard more than one trader express it in this way. It's like this incredibly complex puzzle, and you're competing against all these brilliant people or entities, and you're trying to win at it. So it's that element. So why keep going? Well, a good part of it is they actually enjoyed the game, and so on one side they don't want to give it up because it is something. It's very hard for them to come up with something else that they enjoy as much as trying to win at the markets.
The market is a very good teacher of humility. I can say it from my personal experience, and I have seen it in so many interviews in your books. On the
Yeah,
other hand, when people make a lot of money, it very frequently changes them quite a bit. Some people become more arrogant, or you know what I mean. How does it work with traders? How does it work with people who you have interviewed?
I think in traders it doesn't lead to so much change of personality. At least I haven't observed it. I think the traders have a great range of different personalities, from being aggressive to withdrawn, from being friendly to being ornery. I mean, really quite. But I don't think those innate personalities are changed by the money. The money is usually not the thing. Now, some traders, and in this book especially, you do see where many come from backgrounds of no money or very little money. So there is, in some cases, an attraction to the markets as an avenue where they might make a lot of money. That may be the initial draw, but that's not what keeps them in the game, and that's not what makes them successful. Ultimately, the game itself becomes the important thing, not the money. And certainly, once they make tens of millions, the money becomes less and less significant. Although in some cases, they have philanthropic um, up goals, and so more money is better in that sense. It's not that they need it per se, but they want to have an impact on the world. And one trader in this book references a book. I'm trying to remember the name of the book. I think The Billionaire Who Wasn't, and it's about the founder of those airport shops. The original founder of that, uh, became a multi-billionaire, and he quietly gave away his fortune, and he never really kept much of his money, and most of his life was devoted to really giving away his fortune. And there was a book written about him, and I feel like I think it was The Billionaire Who Wasn't. But in any case, this trader references that because that's kind of his model. And he is at this point, he's a trader, by the way, who went from a $40,000 account to a half billion, at least at the last point I spoke to him. and so he's already been giving away money, but he does it again. He does it secretly. He does it all anonymously.
Well, that's interesting. All right, let's get back to the markets. Since you first started interviewing people for Market Wizards, the markets have
Yeah.
evolved, obviously, quite a bit. There have been a lot of technological shifts, the appearance of quant funds. I think in the end of the 80s, it was mostly like trend following funds, if we speak about any kind of quant funds. And now it's much more significant industry. Retail trading was not that significant back then. Passive investing did not conquer institutional investing world at that time. The commodities market became financialized more recently, like last 20 years probably. And obviously these changes influence the markets. How do you think these changes impacted what makes a successful trader today versus 30, 40 years ago?
Yeah. So, I mean, you're absolutely right. I mean, the markets have undergone enormous change. I mean, in fact, when I did the original Market Wizards book, which I wrote in 1988, I was interviewing people who had made their money in the 70s, sometimes late 60s, but late 60s, 70s, earlier 80s. And, you know, PCs didn't even come widely used until mid 80s, I think, right? So they were operating in not only pre-compute, pre-widespread computer usage, but I mean even the elementary PC usage. Certainly, data wasn't data wasn't. I mean, there was data, but there was not even a sand grain of data compared to what exists now. You certainly had nothing. I mean, you had nothing like supercomputers. You had hedge funds. You had some hedge funds, but nothing like now. In fact, you couldn't have. Now you have multiple hedge funds, which have literally hundreds of PhDs working in the same hedge fund, right? So, so yeah, the changes to the markets are enormous, and actually, you would think, and I actually thought to some extent before I did not this book, but the book before this, where I also interviewed solo traders, and the original version of that I think was about 2020. But by that point, we had seen, all of these changes already. Not not AI anywhere to the extent of what you're getting now, but we had seen all those changes, and I thought it would be impossible to find people with sort of incredible track records, similar to what I maybe found in the first Market Wizards book. And to my surprise, I was finding people who had records that were as good, in some cases, maybe arguably better than even in the original book. And that was certainly true again in this book, where you get, just as I mentioned, one trader going from 40,000 to a half billion. Uh, Quite a number of traders taking relatively small accounts to 100 million plus. So, and some traders having return risk statistics that were completely off the map. In fact, one trader has just no losing months. And by the way, if your readers don't know, we always verify these things. You never take anybody's word on it. So, but literally, one of the traders had no losing months. 11 years, 11 years worth that could be verified, and by his own word, which I have no reason to doubt, another 4 years or so where he's working for a family office, and those numbers are not accessible. So I would say at least 11 and probably 15 years of not a single losing month, uh, which should be totally impossible. And the fact is, this is in the most recent book, and you would think getting track records like this would be more more difficult and more unlikely given all the changes we just discussed. But somehow it isn't. And it seems like individuals, among the many millions of traders who try their hand, there are, and of course, I'm only finding some. I'm sure there's tons of traders that I have no idea exist that are similar to the ones I found. And but the point is, you do, they're out there. You will have traders that, despite all these changes, which would argue against individual traders being able to do this, and would argue for markets presumably becoming more efficient. I mean, that would seem the logical conclusion.
Hmm.
Empirically, it's not the case.
Which leads me to my next question. Do you think there is still some room for discretionary traders? With this proliferation of quant managers, with the ability to process so much information in so little time, what's the edge?
Yeah,
Why are they still having that?
So is there room for discretionary traders? All the traders in this most recent book are discretionary. All but one of the traders in my last Market Wizards book, Unknown Market Wizards, were discretionary. And in all the market books, the majority of traders were discretionary. And there's a reason for that. Uh, if you exclude, when you talk about systematic, I mean, yeah, you do have the Renaissances of the world, which are systematic, these Shaws, and so forth, those type of firms. They're systematic, but not in the sense that people think of it, right? So they're systematic in a way a casino operates. They've got, like, say, hundreds of PhDs coming up with God knows how many systems, and they're trading tens of thousands of securities, not only stocks and futures, but derivatives of those instruments, anything related, and coming up with mathematical formulas of probably hundreds of different relationships. And each of those so-called little systems, and this is none of these shops will tell you exactly what they do, but this is my perception of the general structure of how they probably operate. And I did interview a D. Shaw, who would not talk about specifics, but between the lines, this is what I assume. Um, so they come up with all these systems which operate not just on one market, in many cases the relationships of related markets, and they're looking to just find something that has 51%, 52% edge. I mean, that's good enough. That's what casinos have. I mean, they do not in some games they have a lot more, but in something like blackjack they only have a few percent edge. It works just fine. Same roulette. I mean, depending if it's a zero or double zero. But even so, where you deal 2.5% or 5% edge, you're not talking about enormous edges, but they're money machines because of probability. If you if you have a small edge, or repeat it over and over, and these quant firms are doing this. They're doing God knows how many. I have no idea how many trades you do per day, let alone per year. And if all these little systems have a slight edge, you get something that has a remarkable track record. But that's not what people think of when you talk systematic. That's a different type of systematic. You're thinking about a trader using a system. Oh, here's the idea: when a market has this type of retracement, and it then does this, and the volume is that, and you come up with a bunch of rules, and that's how you decide what to buy or sell. I'm thinking of a system in that type of structure. It's very, very difficult to come up with any system that has remarkable stats of the type that I get, in these people I interview. So it's just very, very difficult.
What do you think about convergence of discretionary and systematic styles?
Like, what do you mean by conversion of a risk?
Some managers can brand themselves as purely discretionary. Others will be purely systematic. But there are people who will be like 75% systematic, but they will say, nevertheless, we will have some discretionary input.
That's pretty common. That's pretty common. So, you take traders like Stanley Druckenmiller is a good example. Great, one of the world greats. Track record. I mean, he's retired now, manages his own account, but I think it was roughly, like 30% average over 30 years, with no, I don't know if he had any losing years at all. If he did, they were very small. Uh, but something like that, he's primarily fundamental, but he definitely sort of times his trades with consulting the technical picture. So not systematically. It's more a matter of, it's not a combination so much of systems, of technical and fundamental. It's more, and like when I say technical, not not systematic technical. It's more a combination of looking at charts to to plan on where to get in, where to get out, and as a cautionary note, if a position is not doing what it should be doing, maybe as an aid of where to place stops and things of that nature. So it's even using the technical side in a discretionary way. But yeah, it's pretty common, and as I just mentioned Druckenmiller, but lots and lots of traders I interviewed who did use fundamentals also use charts in that way, but not in a systematic way. It wasn't that they had a system that gave them buy and sell signals.
Interesting. Speaking about your new book and these next generation wizards, is there anything these guys know how to do that people 20 years ago didn't do or didn't know how to do?
Well, they may have known there are differences. There are things that turned up in this book that didn't turn up in any of the other books. I don't think it's so much about not knowing how to do. I think it's more a matter of thinking that that particular approach was insane. So, quite a few of the traders in this book, surprisingly to me, started out with their initial strategy of shorting small cap stocks, which is kind of uh, a poster child for a negative asymmetry trade, because you short a small cap stock, the best you do is it goes to zero. And on the other hand, those type of stocks, if they went up 300% in a few days, they can go up another 1,000%. Who knows? I mean, there's no limit what, and some of them do. So it is the type of trade where the losses could be much larger than the gains. And so one unifying theme that also occurred in all the other market wizard books is that traders use strategies as different as they might be. I mean, they might range from pure fundamentals to pure technical, but as different as they might be, almost all of them had strategies where when they won more than when they lost. So and most of them lost the majority of the time. It's just when they won much bigger. So positive asymmetrical trades, and sometimes to extreme levels, like a option trader like John Bender, who was a stock market wizards. I mean, when he would put on trades where if he was right, he might make 10, 20, 30 times what he was risking on the trade in terms of option premium. Yeah, he probably lost more than half the time, but his gains were so much larger than his losses. That's what gave him the big edge. Uh, so in this book, you get traders that do something, at least start out doing a negative asymmetry trade. Not that people didn't know it before. It's just I think nobody ever thought that was a particularly good thing to do. But in this book, for some reason, a number of them did and did well at it. They all eventually moved away from it because as they got bigger, uh, they were the risk inherent in that type of strategy was something they didn't want to do, and moreover, it couldn't scale as they got bigger. They could no longer trade the money they had on using that type of strategy. Um, but anyway, that was the difference. There was also one trader who when he did change went into selling options, which is another poster child for a negative asymmetry trade. Um, he was able to make it work very well for him, but I think it had to do with the fact that he's one of the traders in this book, of one of quite a few, who seem to have been born with an instinctive risk management reflex and just a knee jerk reaction of getting out very quickly when they're wrong. So even though he's using a strategy which for most people would be in the proverbial sense picking up nickels in front of a bulldozer, in his case, uh, he can make it work because he never gets close to the bulldozer, so to speak, to continue the analogy. And that's only because, and a perfect example. When President Trump came up with the so-called Liberation Day tariffs, uh, if you recall, the market took the took a very, very quick, huge plunge over a course of I think 4 or 5 days, uh, and he was fully short options in that on that particular day, which would seem to be a recipe for disaster. But what did he do? That the first day, not the second, but the first day, and not any time during the first day, but right at the opening of the first day. Not only did he cover his entire position, but the way he covered it was he hedged by buying S&P puts to offset his entire exposure. Why? Because he could do that instantaneously. Whereas if you're trying to work out of hundreds of option positions, it would take time, and it would be much more slippage. So he just completely hedged his entire position instantaneously at the first on the first opening of the first day, and that's who he is. That's his reflex. So he can get away doing something like selling options as a strategy, because when things really go bad, he's his natural instincts get him out quickly. Now there is a way where that could still blow up, and I did ask him that, and I said, "Well, okay, sounds good. That's good, but what happens if we get an October 19th, 1987, when the market gaps over the weekend,
Hmm.
and the market gaps open 12% lower?" And he says, "You're right. I can't. There's nothing I can do to protect against that. But here's the thing: over the years, he's made money, so he no longer has a major part of his wealth, in the trading account. He's still trading, I guess, tens of millions, but has other money elsewhere, right? So he's not exposing entire wealth. So yeah, if we get another October 19th, 1987, and I've been in the business for a long time, that is the only instance I can think of that I've seen like that, where you get of that type of an overnight move. Um, so I mean, there may have been others, but I don't know. But in any case, uh, that's the only protection, is that the size you're exposing to that trade has to not be. You can't expose all your wealth to that, because no matter what you do, there's a risk.
Yeah, that's for sure. But even buying put options on S&P on Liberation Day would have been quite an expensive thing to do, because
Yeah,
obviously volatility spiked
yeah.
already.
He lost money, should be sure, but I think he only lost $1 million, which was, you know, which is trivial compared to what the trade could have lost 10 times that, 20 times that in a few days.
Okay, so then we're naturally coming to my next question. Failures. All traders lose money. There are some exceptions, some amazing people, but in general, people lose money in the market and they have very nasty drawdowns. How do good traders cope with this?
Yeah. So that happens to the best traders sometimes. And the trader in this book, for example, the trader in this book who I mentioned who made a $500 million. There were actually two traders who did that. But one of them, um, he he actually, well, it's interesting. His equity curve, once he gets going, it looks like a little mountain, uh, for most of the beginning and for the end. But there's one big blip in the middle, and I asked him what happened. Well, what happened was he took a trade. It wasn't even this conventional trade. It was just kind of a spur of the moment thing, and he just took it, and then he kept on. Instead of getting out, he then added to it, and he let just this one bad trade just mushroom, and he did it actually a few times. It happened. There were two trades in that window where he did that with, and turning what should have been $1 million loss or at most or something, letting it go into 50 million or in one case $100 million loss, and and that was just breaking his own rules. It could never happen if he literally followed his own rules, and he was good enough to recover. In fact, in a few months' time, I think he was able to get back to a new high. But those were big mistakes, and somehow they these traders, when they do have that, they are able to come back. That those giant losses, sporadic as they are, don't completely sink them. They have enough skill and enough confidence that they're just able to bounce back. Um, yeah,
But don't you think that confidence in yourself is akin to confidence in a position that you have? Let's imagine that you have a position on the market, and this position starts losing you money. The natural thing is to shut down that position, right? Because you want to cut your losses,
yeah,
right? Now, imagine that you yourself is some kind of position, some kind of strategy. And if the strategy called you the trader starts losing money, it's the same thing as if any other position in your portfolio is losing money. You should just cut your losses. Nevertheless, these people continue trading. Why not just stop themselves out and forget about it, find a job, and do something else?
that's one of the things that you get when you interview these people. You see that one of the ways, and in fact, quite a number of traders in this book, and also true in every market was a book for some traders, do blow up in the beginning. And there's one trader, I think one of the chapters I titled "The Fifth Time is the Charm" because he blew up 4 times before he succeeded. So one of the things about these traders is they have such a drive and such a sense of confidence which doesn't seem to be initially rooted in any type of justification. I mean, you would say, in one trader's case, basically he says, well, the first time it took me 3 months to blow up, and the next time it took me 6 months, and then the next time it took me a year. Now, most people would think I blew up 3 times, but he thinks, well, it's that I'm lasting longer. I'm obviously getting better, and I just have to keep at it.
That's good. That's good mentality.
That's a different mentality.
Okay. Do you think that trading principles can be applicable in everyday life, like beyond trading?
Yeah, I mean, certainly certain basic principles, which may be a cliche, but it's one of the truest cliches ever spoken, is cut your losses short. That's a good way to. It's applicable to trading, but it's applicable to anything. Yeah, I think it's applicable to life too. If you make a decision of something and it's a wrong decision, and there's no you're better off, okay, just acknowledging this was a wrong decision. This has not worked out. There's no point in just keeping at it and digging the hole any deeper. I think it's true in a general sense. So cutting your losses short, I think, is a good way to live your life in general.
Okay. You have interviewed both prop traders, hedge fund managers. I'm not sure if you have spoken with institutional investors, but can you compare them? Are they the same, or do they have different approaches to trading?
Well, yeah. So I've interviewed both solo traders and hedge funds, and sometimes very large hedge fund managers. I think on the trading side, there's a lot of similarity. Obviously, hedge fund managers need something else. They also need a desire and an ability to run a large business, which is not true. I mean, there are plenty of traders I've interviewed that the last thing in the world they would want to do is run a business, and they just want to trade. But traders who end up running hedge funds are have this other side of them that also can be skilled at running a large company and managing people effectively and sort of leveraging their skill in terms of having a larger organization. So I think it's an additional type of interest and talent. But when it comes to just if you isolate just the trading portion, I can't think of a definitive difference between the so-called hedge fund managers and the solo traders on the trading side. They all use different approaches, but they also have common unifying themes, like some of which we mentioned, like the risk management, hard work. Others we haven't talked about, like uh, discipline, flexibility, the ability to change their mind on a dime. I think those things are true both of the individual traders and the hedge fund managers.
Okay. Uh, I think one of the greatest implementations of the cut your losses short principle is the multi-strategy funds model, like the pot shop model, where people hire a lot of traders, and once you hit your drawdown limit, you are out. Basically, it's a trend following strategy on your traders. What do you think about this model, and what do you think is going to be the effect of multi-strategy funds on
Yeah,
the markets?
the model of multiple traders. So yeah, um, yeah, I mean that's an effective model. That's an effective model, and I mean there are firms like Millennium and Balyasny. I mean that is their model, and they've done quite well with it. And it makes sense because what they're basically doing is finding traders who have different approaches, so you get diversification and have an edge, and putting lots of them together. So you come back to this the advantage of probability when you have multiple edges, putting them together, you get a an equity stream that is quite attractive. So I think I think that model makes a lot of sense.
Looking at it from the other side, the talent pool is limited, and people who are good traders who find their way into one of those big pot shops, they hit their drawdown limits, they fix their strategy, they move to the next pot shop and start from a clean slate. What do you think about this turnover of people between the funds?
Obviously, if they're in a drawdown and have to get back to high watermark uh, at the old firm, and they go to a new firm where they start fresh. So from their own individual perspective, yeah, I mean, it's an obvious benefit to doing that. Um, of course, yeah, as far as investors go, that drawdown never gets recovered, and yeah,
Don't you think that this kind of approach also incentivizes more frequent strategy, high frequency strategies, not necessarily high frequency strategies, but high frequency strategies, because these strategies allow you to have higher Sharpe ratio, the probability of hitting the drawdown limit is lower. So it makes a lot of sense to go with these strategies, even if you know that they're going to be arbitraged away. Maybe in a year or 2 years, it doesn't really matter, because in this year or 2 years, you're going to make some money.
well, anything, yeah. I mean, if a high frequency strategy works, then I mean, there's no ultimately you everybody's trying to pursue one of two goals, sometimes both, which is make as much money as you can in terms of trading, uh, or or get the best return risk that you can, or some blend of the two. And any if high frequency is a means of doing that, then logically you would do that. You want to use. It's going to be different for everybody. It's going to be different for every trader. What the right answer is, and each trader finds their own answer to what approach will give them the best either return to risk or the best cumulative gain. Uh, Different traders have different weights to those two objectives. So the trader I mentioned that never had a losing month is, he's like 99.9% on having the best return to risk and almost zero on making the most money, and uses an approach which doesn't allow him to do that. But in any case, for every trader, the answer is different. And it also depends on what their balance is between cumulative gains versus the best return to risk. Those are not always mutually exclusive, but they can be, depending on the strategy.
All right, switching gears a little bit. You have interviewed so many elite traders, like best of breed. Have there been any surprises to you, like anything that was standing out?
Yeah, so surprises early on, I was surprised when the first market was about that a number of these traders with great records had early complete failure. So that was initially a surprise. But then I found that pattern in every book I did. So by this point, I'm no longer surprised by that. I was surprised in this book, as we talked about before, that some of the traders used what I would call negative asymmetrical approaches, and it worked for them. I would not have guessed that would be an approach that ultimately led to highly successful careers. So if I had to name a surprise, I would say that would be it.
Has interviewing great traders made you yourself a better trader?
It's made me go from, I'm a terrible trader, but it's made me go from, let's say, initially being a losing trader to being net profitable. It doesn't turn me into a market wizard. And I think that's a realistic expectation for anybody who reads my books. I mean, there are, most people are not going to become market wizards, no more than most people are going to, if they're a sports fan in any particular sport, are going to end up playing for a professional team in that sport. Only a very tiny sliver of the population has the innate talent to excel in any endeavor. But anybody can improve by doing the right things. So the realistic way to look at it is wherever you are in your trading, you can get better by gleaning the advice of people who've been very successful.
Okay. Now, if we think about the biggest misconceptions which people have about star traders, I think you already covered the biggest misconception that ordinary people have about them, like it's very easy to make money in the market. What is the biggest misconception that professional investors, like institutional investors, hold about the successful trading?
Well, I think in some cases people will dismiss it and say they're lucky, but if you think in terms of how far from an efficient market result these results end up being, that's not a plausible argument. So obviously, a trader doesn't lose any money, has no losing months. But so I think one of the misconceptions is to dismiss some of these track records as being a matter of luck, when it's not a matter of luck, when it's a matter of the markets are not efficient. Yes, they may be efficient at times. They may look like they're efficient, in a way, but they clearly are not efficient because there are many episodes and occurrences that just would not happen if markets were efficient. I mean, for example, I mentioned October 19th, 1987. The market's down that day. Well, the futures, the stock market never actually caught up because the tape ran late all day. But the futures, which discounted, I mean, if the futures were down like 29% in one day, that the probability of that happening in an efficient market world is so remote. I mean, and similarly, when you look at individual track records, I'll take one where I did the calculation. One of the traders I interviewed and that was in hedge fund market, was Ed Thorpe, who was famous to the world more for the fact that he figured out how to beat the casinos at blackjack, and wrote the famous book Beat the Dealer, which ultimately changed the way casinos operated, and sort of the approach couldn't be used anymore because of multiple decks and reshuffling, and also if somebody did get past that point of casinos looking for people who use the logic of that book, which was to uh, count cards to know when the odds are better and when they're worse, and bet heavy on the good odds hands, and very little to nothing on the bad odd hands. So it became that people who did still were able to use it would get thrown out of casinos. So it ultimately became unusable. But that was his initial claim to fame. He eventually figured out that he could make more money in the markets than he could trying to beat the casinos, and ultimately came up with multiple strategies. But the first hedge fund he ran, he had 19 years with only 3 losing months, all less than 1%. And I did a simple binomial probability calculation on what the odds are of getting the results. And it was a conservative calculation because I assumed that the odds of winning and losing were the same. I'm sorry, not the odds were the same, but that the amount won and lost was the same.
Which is not the case, of course.
Which was not the case because he won more on the winning months, which were almost all the months, than he lost on the losing months. But anyway, even on the conservative assumption, I had the number was so insane. I think it was 10 to the 160th, and I had to come up with some analogy that would make it tangible to most of the public. And so I did come up with this analogy. I actually looked up on, I think it was Wolfram, what the probability was or not what the probability was, but how many atoms were in the mass of the Earth. And I think it turned out to be 10 to the 80. So if you break that down, the implication is if you did the following experiment, you randomly picked an atom from the mass of the Earth, not the surface, but the entire mass. And then you randomly picked another atom and picked the same atom. That probability is much greater, trillions of times greater than Ed Thorpe's record if the markets are efficient. So my point is that there are many of the traders I interviewed whose records would just be impossible probability-wise if markets were efficient. And no, they're not lucky. They have figured out a way to actually beat the market, and they do it over long enough periods and with enough consistency that you can't just dismiss it as luck. So I would say that's the misconception that many people have, particularly in just the straight investment world, that no, you can't beat the market. The people who beat the market are just lucky. Yes, some of them are, particularly if they're trading over a shorter period and if their records aren't that spectacular. But the very long track records that are absolutely out, yeah, well, let's just say on a conservative way, 10, 20 standard deviations. Those records are not luck. They're because a trader has figured something out and is able to implement it.
You know that in some movies, in the end, they show some footage which didn't make it into the actual movie. Have there been any fragments of the interviews which you liked, which you remember, but which for some reason didn't make it into the books?
I do have a deal with the people I interview where I tell them that I won't publish it. I'll let them see the final draft. And if there's something that's in there that's problematic for any reason, well, if it's incorrect, of course, I'll gladly change it. But if there's something there that's not incorrect, but let's say they don't want in for some reason, um, then I'll work with them to try to make it so it can be included. And that can be It's happened a few times where uh, there was some very disparaging remarks about people, and they didn't want to name the specific person, so I would use a pseudonym.
Okay. And finally, any advice you can offer to our spectators, listeners, someone who is building a trading or investing career in today's environment? What
Yeah,
should they do? And probably more importantly, what shouldn't they do?
yeah. So we've talked about a number of things already. Uh, on the risk management side, for example, and the fact that if you're going to want to succeed, you really have to have some devotion and passion for it. Uh, I think anybody who's purely motivated by money is not going to. That's not a good motivation. You have to have more to it than that. But there are certain things that a lot of traders who were very successful do, have done, continue to do. And I'll give you. There's many things, but let's take one that can relate to anybody, no matter what trading approach they're doing. And you will see if you read my books that many traders are almost religious about keeping a journal of trades that are significant, either because they they worked out, they they followed a strategy and they worked exactly as the strategy indicated and is a good model. And more importantly, they deviated from what they should do and the trade lost money. It's not the trades that lose money that are significant, it's the trades that lose money because the person deviated from their own strategy and rules. And the importance of writing that down and keeping that as a journal is, and reviewing it, of course, if you just write it down, that's not enough. All of these traders periodically review it at the end of the week, at the end of the month, at the end of the quarter, at the end of the year, sometimes all of those. The idea is by seeing black and white, let's say, for example, here's where I lost money because I did something that was wrong. Wrong, not in the sense that I lost money, but wrong in that I deviated from what I knew was the right thing to do. That will mitigate, or a better word would be is reduce, or ideally eliminate, but at least reduce the number of times you make the same mistake. And one way to become a better trader is to eliminate mistakes that get repeated. All traders make mistakes, and all traders repeat the same mistakes. Rare is a trader that makes a mistake, one type of mistake, only once and never repeats it again. So making note of that and reviewing that is a way of uh, of catching it. So the next time you're about to do the same thing, you remember, because you saw it in black and white. You did this the other time, and it was the wrong thing to do. You're not going to do it again. So that's one piece of advice drawn from what many traders in this book and in all the Market Wizards books, you'll find traders that do it. In this book, I think particularly predominant to some extent, and that is this journaling to reinforce trades that do the right thing and to burn into your mind not to repeat the same mistake.
All right, Jack, thank you so much. It's been so much wisdom condensed in less than an hour. Really appreciate it.
Sure, glad to do it.